So let's be honest. Has anyone been left reeling since they heard the announcements at the uh, federal budget night, 12th of May? I am actually recording this in on the 14th of May 2026. So if you're watching this after the fact, that's the reference point for this video, this podcast. Um, so I really wanted to just make comment on all of that because I know many of my clients are investors. And when we first heard that there's going to be changes to negative gearing and capital gains tax, then we wonder how that is going to affect us. And for many of you watching this, you might not really understand how it does in fact affect you, or you might think, is it actually worth me starting to have any sort of investment? So I really want to talk about that, but I do want to issue a disclaimer first of all to say that this is just general advice. It's just my general reaction to what has been said, my personal opinion, really me just explaining what has been said. But for you individually, you need to talk to your finance people, those people that you have in your life. Your accountant is a tax professional, they are experts in the area of tax. Your financial planner will look at your overall financial planning. Well, how does this impact you? So you really need to talk to those people because they know your particular position and your financial position in particular. I do not. And so I'm talking generally. And so what might be right for you may not be right for me, and vice versa. So you really do need to talk to those professionals. So having said that, let's look very quickly at and very briefly at a bit of an overview of what was actually announced. So I'm going to talk to two types of people. The first one, I'm going to talk to people who already have investment property now. And of course, this does relate to all kinds of assets classes with regard to an investment, but I'm talking and referring specifically to investment properties. So those people that are already investors, and then I will talk about those people who are going to be new to investing. So bear with if you're in the second category. So with regard to capital gains tax, first of all, there are definitely some changes. If you have owned an investment property since before 1985, up until budget night, you were not required to pay capital gains tax at all. But so let's say if you sold your property prior to budget night, you would have not paid any capital gains. But if you then realize gains after budget night, so they'll discount the amount of gains you've earned before, after budget night, you will be charged capital gains tax on any increase in value, any capital gains that have happened after budget night. the original purchase price is increased to match inflation before your capital gain is calculated, and there will be no 50% discount like everybody else. After 1985 they would have got that, and you'll be charged at your 30%, at a 30% tax bracket. So if you, like many people, have owned a property since 1985, then any increase on that value from budget night will be different and will be charged differently than it would prior to that. So let's say, for instance, you have seen growth in your property that you purchased after 1985. You will be charged 50% discount if you've had it longer than a year on the increase in the value of that property before budget night. Any increase in value after budget night, then your original purchase price is increased to match inflation before the capital gain is calculated. So no 50% immediate write-off after that date. You will still get it before, but after that date, it will not be there. It will go with regard to inflation, and you will be charged at 30% tax. So what this really means is those people that used to fall below the tax-free threshold, or those people who were in the 16 cents in the dollar tax bracket, that no longer is relevant. Everybody will be at a minimum charged 30% tax. So there's some significant changes there. Now let's talk about negative gearing. And this is good news for present day investors. So if you have got investment properties already and you have you purchased your property before budget announcement night, so the 12th of May 2026, then the negative gearing rules still apply to you that have always applied because of that good old grandfathering rule. So the grandfathering rule means that what was in place prior to budget night will still be in place for you with regard to negative gearing. So let's just give a bit of an explanation about what negative gearing is. So we have positive gearing, we have negative gearing. Negative gearing is when your expenses for an investment outweigh your returns. So let's say, for instance, I have an investment property and it costs me out of pocket $20,000 a year. That property is negatively geared on the old rules and up until budget night. So what you could do was you could have it would be based on what is your income from your wage or your salary. Now, what is the income from your investment property? And then let's minus all of the expenses associated with that investment property, including the interest charged on any loans that you have. Now, if that then reduces your taxable income, you are charged tax on that reduced taxable income. So that is fine up until property's purchased and if you are an investor prior to budget night. But now let's talk about new to investing. If you are new to investing, that negative gearing will be very, very different. So let's talk about negative gearing first in this category. So we're talking about new investors. Anyone who exchanges on a property after 7:30 p.m. on budget night will not be able to claim tax paid on rental losses. So that's a very different set of circumstances now. So let's look at that. So now if you buy a property that gives you a loss, you can only claim those losses against any gains on other investment properties, on other investments. You cannot claim it against your taxable income. So like I just quickly explained to you, normally it was income from your wage or your salary plus your rental income minus your losses from your investment property. Not so anymore. After budget night, your income is taxed completely separately. The only way you can claim any investment losses is against gains from investing. So if you're gaining some income from some investments and you have a loss in an investment property, you can claim against that, but not against your overall salary. So that will be a big downer for a lot of people, because some people from a high tax bracket are trying to reduce their taxable income by negative gearing on property. So that's not going to be good. The only way that you can actually claim negative gearing against your income is on a newly built property. So when I said you can't claim negative gearing on any new bought property, I was talking about property that's already there. So you're buying a property in a residential area that is already there. No, can't claim any negative gearing, but unless it's against positively geared properties. But if you are buying a newly built home, that genuinely adds to the housing supply. So that's a bit of a caveat. So if you buy a newly built house, yes, you can be negatively geared against your income. But if you buy an existing property, knock it down and build another one, that's not classed as a new build. But if you buy an existing property, subdivide and build multiple properties, they are classed as new builds. So that is a very different thing. So that is something that's very different when it comes to negative gearing rules. Let's talk about capital gains tax if you're new to investing. So if you buy an investment property after budget night, then you will get a discount that is equal to inflation over the time the property is held. So forget that 50% discount, that's not happening. So that means when you sell an asset like property, or it could be shares, anything like that, the government taxes you on the profit that exceeds the rate of inflation. So instead of receiving that 50% flat discount on your total property, on your total profit, your original purchase price is increased to match inflation before your capital gain is calculated. So what this does is this actually ensures that you are taxed not on imaginary gains, but it only reflects the rising prices that are actually increasing your wealth. So who's better off with these rules? This is quite an interesting question, isn't it? When it talks about tax on real growth, you only pay tax on what you gain above inflation. So if your property keeps step with inflation, then you're better off than with the 50% capital gains tax discount, aren't you? If you keep in step with inflation, then we're actually looking at the fact that your tax liability is effectively zero. But if you have that high growth, when assets doubles in value quickly, it goes well above inflation, then maybe the 50% discount would have been better. You're never going to really know that. Well, I'm going to know that really in hindsight, what that looks like. So that is really what capital gains is all about. So, when I looked at this, I thought, what's the take from all of this? I believe that your best course of action, like I said right at the beginning of this recording, would be to talk to your accountant or your financial planner, because they know your situation in depth and they can give you very specific advice. But sometimes I think when we hear these announcements, we think, oh gosh, what are they trying to do to me? What is this going to do? What I thought was the reason for my investing may now have changed. So I think it's a really good idea to look at why the government have said this. And I think in general, they're really doing it to help the housing market in their opinion. So what I did, I actually had a look at a document. It is the government 2026-27 tax explainer document, and it's specifically addressing housing impacts. So just would like to read something from there, and then I'll make comment on it in a minute. So it says under the housing impact heading, these changes will support more first home buyers to enter the housing market over time and form part of a package of reforms that will support supply overall. Treasury modelling suggests that the reforms will increase the owner-occupier share of the housing market, resulting in around 75,000 additional owner-occupiers over the next decade. So this is equivalent to reversing around 10 years of declines in the home ownership rate. The reduction in investor demands is expected to lead to a small and temporary slowing in house price growth, estimated to see prices grow by around 2% less over a couple of years relative to the no tax policy change. Lower house price growth will have a small impact on housing supply, more than offset by the additional homes supported by housing supply measures in the budget. The reforms are likely to have a small impact on rents, with an expected increase of less than $2 per week for a household paying the current median rent. That's a lot of words, isn't it? But really, let's have a look at that. What they're trying to do is to address the fact that many people trying to get into the housing market feel that they are bipped at the post by an investor coming in. And the natural assumption is that that investor's got a lot of money and can bid higher, and that's what's pushing up the market, the growth of the property prices. I'm not thoroughly convinced that that is the case. A lot of investors entering the market have got to compete the same way you do. They too have to go to the bank and borrow money, but maybe they're getting into the market because of the negative gearing abilities to offset their income. So maybe we will see less investors going into the market as a result of that. And that would be a good thing for first home owners. For those people that have got a lot of property that is positively geared and they're trying to offset that positive income, they'll still be in the market buying property that they can offset positive geared properties by. So, and probably that is less in the market than those people that are just in it to try and get the negative gearing of their income. And what they're trying to do is get additional properties built, not just working with the property that we presently have, but if you are an investor, get you to build new property so that we actually have an increase in the amount of property that's available for renters and the general population to have more property. So really looking at it, you can see what they're trying to achieve, but we won't know that until we see what happens from now on in. Will there be a sudden glut of investors that were only in it for negative gearing against their income? Will we see them wanting to offload their property? And will that mean there's a sudden glut of property in the market and therefore house prices come down? We don't know. So let's wait and see what's going to happen. But if you do have any questions or comments for me, I would love to hear them. And so please do send me an email, chris@coachchris.com.au. Put a comment against this podcast or this YouTube clip, and let's talk.